We'll just start in next 3 4 minutes. Yeah.
No problems. I'll I'll be able to share my screen, right?
Yeah. Mm. Hi, Shashank.
Hi, Pankaj. You able to hear me?
Yes. Yes. Very
Uh,
good.
I cannot start my video because it has been disabled. My
Sorry.
video has been disabled.
Acha, no problem. No problem. We'll start, Shashank. Yeah. So good evening, everyone. Thank you all for joining today. So today we'll be talking about Trust Small Cap NFO. So just to brief you about the company, Trust Group promoter is Utpal Sheth. He's also CEO of Rare Enterprise. And if you talk about wealth management, Trust Plutus, they are managing more than around 17,000 crores. So this is the second equity fund they are launching. First was in April, that was in FlexiCap category, and it is one of the best performing in that category. So this is the second fund which they are launching. So we have Mr. Mihir Bora, who will be talking more on this category, this fund. So Mihir Bora actually doesn't need any introduction. So I'll just brief, but yeah, so he's a chief investment officer at Trust AMC. He has more than around 3 decades of experience, and he's one of the CIO like who has hold on both equity and debt side. Like very few CIO I have seen. They are like some are good in equity, some are good in debt, but he's one person which I have met like who has hold in both the categories. So that's something really good. So before joining Trust Mutual Fund, he has held a senior position in and chief investment officer at Max Life Insurance, where he was handling more than 1,30,000 crores. And earlier he had worked with all major AMC like Aditya Birla, then HSBC, ICICI, SBI, ABN AMRO. So all big companies he has worked with. He's a mechanical engineer. He has done his IIM from Lucknow.
Meena, are you able to hear me?
Yes, sir. No, now we can hear you. Yes, sir.
Yeah, and he's also a chartered financial analyst. Yeah. So over to you, Mihir. Yeah. Thank you.
Hello, Meena?
Yes, sir. We can hear you.
But your video is paused.
Yeah, so your video is paused, but we can hear you, sir. Please, sir, can you hear us?
My video is paused. Okay. So,
Mihir, your video.
but because I can't see Pankaj or anybody also.
Oh, so I think you have to re-log in something.
So should let me log out and log in again?
Yes, please.
Hello?
Pankaj asked host to enable videos. Videos have been disabled by the host.
Yeah, even my video is disabled, so it's okay.
Is it? Okay. Yeah.
Video access has been given to Pankaj and Mihir only.
That.
No worries. Pankaj sir, Mihir sir will again rejoin, so maybe we'll have to move him to panelist. Hi, Shashank sir. Good evening. How are you?
I'm fine. Your video has now been enabled, I believe. The Mir also has joined.
Sure. Oh,
Yeah. Can you hear me now?
now it's perfect.
Okay, good. Thank you. Sorry about that. I thought there was problem with your end. Apparently, I was frozen.
Right, sir. So, Mihir, you can start. Yeah. You can share the presentation.
Okay. Meena, you want to just give the background of what we are doing?
Sir, Pankaj sir actually spoke. I think you were not able to hear you. He introduced you, the group, the
Oh, so sorry.
promoters.
So sorry about that. So sorry. So at least we didn't waste time then. You could do something while I was disconnected. The audio is okay now, na?
Yeah, it's very clear now.
Okay, great. I'll share the screen. Is this visible?
Yes.
Okay, great. So I think we covered the part. So first of all, thank you everybody. Sorry about the glitch, but as I understand, the time was not wasted. There was introductions done. So I'll skip the group part. And the fact that the Trust Mutual Fund way has now been well established, at least for the last 6 months that we have the track record of our FlexiCap fund. What I would like to just summarize in terms of the background is that in our equity investment philosophy, we do have a very distinct and credible philosophy, and that kind of flows from our own DNA, not from anything.
Meet, sorry. What I was saying, like I just briefed about the group, but if you can just take them across through the presentation, that would be better because many people want to understand more about the group. Yeah.
Group also. Okay, I'll do that then. No problems. So the trust group essentially is founded by Mr. Utpal Seth and Mrs. Nipa Seth. Utpal comes from a very deep background of investments. His family is a broking family, one of the old broking families from the Bombay Stock Exchange. The firm's name was Hemendra Seth. In the late 90s, Utpal, the family business was shut, and Utpal joined Inam Securities in investment banking. But even when Utpal Seth was running the family business, the business was run with a institutional kind of approach. They had all the leading institutions as clients, and Utpal actually used to head the research for the function for the business. And he was in the 80s, he was among the first pioneers, I would say, of equity research, when equity research was not even very well understood in India. So it was kind of the pioneer of equity research in India. Then he joined Enam Group, and there he came in touch with Mr. Rakesh Jhunjhunwala. Rakesh Jhunjhunwala appreciated his research approach, his long-term thinking, and offered him to become a partner. So for the last 25 years, Utpal Seth is partners with Rakesh Jhunjhunwala, and he's still the CEO of Rare Enterprises, which is the family office of Mr. Jhunjhunwala. So extremely good experience in terms of equity research and investments, so to say. When in the late 90s, when Utpal joined Mr. Jhunjhunwala, Nipa, his wife, again very well qualified, ranking chartered accountant and CFA. She started the debt broking business, and today Trust Capital, which is the debt broking business, is the #1 non-bank debt broking house in the country. All major banks, institutions, corporates, governments, public sector units, central government, state government, etc., cooperative banks, etc., are their clients in the debt market. So extremely profitable, large business that she has developed over the last 25 years. So Utpal expert in equities, Nipa #1 in fixed income. So the group has a unique DNA of being experts in the capital markets across asset classes. About 12 years ago, they also started the wealth management business, which is run independently by a professional, ex-City banker, Mr. Samir Kaul. And today, from zero, they have now assets under management in wealth of about 17,000 crores, about 7 offices and 50 odd relationship managers. And it's like a ultra HNI kind of a wealth management business. So again, running a very successful wealth management business. Mutual fund business is the latest addition to the family, and there we started with the basic fixed income funds about 4 years ago. Launched the first equity fund early this year after I joined. Today we have about 770 crores in the first fund that we launched, which is the Trust Flexi Cap Fund. And here we are kind of launching the second fund, which I'll talk about. So I would say that in equity, we have a very clear and credible, consistent philosophy and process, and I'll talk about it as we speak, which is growth at reasonable valuations with terminal value investing. I'll also talk about that in a little bit detail later. But suffice to say that when we talk about the trust group, there is a differentiated approach, and there is a DNA of investments that we carry, which we believe is kind of unique. I can probably name about 5 or 4 out of the 44 AMCs in the country, which can be proud of the fact that the promoters themselves have a capital markets background. For example, maybe a place like say Parag Parikh has a background where the promoter is from the markets, maybe a Quant Mutual Fund, maybe a White Oak, and maybe a Helios. So maybe 5 or maybe, and if you really stretch it, probably somebody like a Mire, where the global promoter used to be an investment banker. So maybe 5 out of 44 AMCs, we can say that they have investments as their original DNA. Most of the other AMCs are typically by financial institutions or by business houses, but not with promoters who have themselves, dirtied their hands managing their own money or other people's money. So I think we come with that kind of a background, and more importantly, the investment philosophy that we bring, which I will explain in 5 minutes, is also something that we believe is a big differentiator in our own track record for the last 6 months. We have kind of demonstrated it. We did touch base with a lot of you 6 months ago when we launched the first fund, but that time the whole idea was in a PPT, so to say. We were only theoretically talking about what we stand for, while we have in our previous roles, and Utpal in his personal capacity has obviously implemented these. In this format under Trust Mutual Fund, obviously it was more on paper, but now we have the portfolio and the track record for the last 6 months, and it clearly shows that we have implemented exactly what we had kind of projected on paper. So let me explain to you where our investment philosophy stands. At heart, we are growth investors because we believe that ultimately it is earnings that drive stock prices, right? In the long term, if you plot a chart of any stock for that matter, ultimately the EPS is what drives the stock prices. As the EPS rises, the stock price rises. Of course, there are years where there is an overshoot of price, there is an undershoot of price. But if you look at a 10, 15, 20-year kind of a track record, the only determinant of stock prices is earnings growth. So for us, it's important to project what the earnings growth for a company is likely to be. So this is what we call typical growth investors. And then, of course, you want to pay a reasonable valuation for it. I'm not saying price, because price has a connotation of cheapness. For us, it is very important to value the business correctly. And I'll tell you what the fine difference is. It's not a semantical difference. It actually makes a difference to how you look at a stock. But let's look at the different styles of investing first. There are pure growth investors who invest only in stocks which have the highest profit growth. Not so much importance to growth, as you can see. There are pure value investors who only want to look at cheap stocks. They start with cheapness as the criteria. Not so much importance to growth to start with. Then there are price momentum players, where the key determinant of whether a stock is in the portfolio or not is price momentum. So basically, you are chasing whatever is working. We pay equal importance to valuation as well as to growth. But by valuation, what we see is not only the near-term valuation, we look at the long-term growth also. And let me explain to you with a real-life example. Mr. Jhunjhunwala's and Utpal's most successful investment was Titan, right? And in 2004, 2002, when they acquired and became the largest shareholders in Titan, the market cap of Titan was about 4,000 crores, and the profits at that time were about 80 crores. So 4,000 by 80. The price to earnings ratio, as we would call it today, was about 50. Now, 50 is a high price to earnings ratio by any normal kind of comparison. But that was the fact. Titan was a growth stock even at that point in time. So the profits were 80 crores and it was growing at say 25%. So 80 was expected to grow to 100 crores next year, 125 crores the year after, 155, 180, so on and so forth for the next few years. The thing is, if you total if you simply total, not even do a discounted cash flow, but just total the profits for the next for the 5-6 years, it would be 500 crores or 600 crores. But the market cap is 4,000 crores. So 600 crores is the value of the foreseeable profits. 3,400 crores is coming from where? That is the value that the market is paying for the future profits. Now, the thing is that in high growth, and the emphasis is on the word high growth. In high growth stocks and sectors, when the market or when you do a discounting, when you do a valuation in terms of what the market cap of a company should be in the future, there is a disproportionate impact of the longer term profits. In this case, for example, while you could foresee only 600 crores in the next 4-5 years, the market is paying another 3,400 crores to the back-ended profits, which almost 85% of the market cap is coming from the back-ended profits. And this happens in all high growth stocks and sectors. 80-90% of the valuation would be explained by the back-ended profits, by the longer term profits. Now, the problem is that predicting the near-term profits is easy. Trying to project the longer-term profits is difficult. So normally analysts, what they do, any research report, if you see, they project for the next 2 to 3 years and say that this is the profit EPS after 3 years or 2 years. Based on this EPS and today's price, this is the PE for the for FY26 or FY27, and the PE is 35 or 37. It's expensive given the growth of 25%, etc., etc. But the problem is that in case of high growth, if you look at the price to earning ratio on the next few years profits, it always will look high, because whether you are looking at it or not, the market is discounting the back-ended profits also. This is the value of the back-ended profits is called terminal value, right? Terminal value is the value of the profits beyond the projected horizon. This is our approach to valuation. So when we say growth at reasonable valuations, we take into account the longevity of growth, not only the high growth for the next few years, but how long the runway of growth is going to be. This enables us to put a value for high growth stocks with a little more accuracy than what the rest of the analysts tend to do. Because, as we say, India is a high growth market, and within a high growth market in India, there are stocks and sectors which are growing even faster than the rest of the market. So there are many stocks and sectors expected to grow at 15, 17, 20, 25% for 5, 7, 10, 20 years, for example. And in these cases, 85, 80, 90% of the market cap is explained by the back-ended profits, not the near-term profits. So if you look at the current PE, they will always look high. In Titan's case, for example, the PE was 50, right? And the market cap was 4,000 crores. Today, the profit is 4,000 crores almost. The profit itself has gone up by almost 50 times, and the stock price has gone up by even more than that. So in these high growth stocks and sectors, you don't have a choice but to have at least some rough idea of what the terminal value of this high growth stock or sector is likely to be. And this is what we acknowledge. This is what we try to, there is no accurate Excel spreadsheet that you can make it, but there are various ways of kind of using surrogates or substitutes or ballpark numbers to arrive at some kind of at least ballpark number to see how long the runway will be. So for us, it's important that the runway is long. Of course, high growth is important, but equally more important is how long the growth is going to last. So this is the terminal value philosophy that differentiates our approach to growth investing. So that differentiates our investment philosophy. And this is what we have, used in our FlexiCap fund for the last 6 months. The portfolio is there for you to see, and this is also what the equity philosophy remains the same. So even for the second fund that we are launching, the small cap fund, this is the same philosophy that we will continue to use. So with that, let me start with the small cap fund. I'm happy to take questions in the middle also. So if somebody has questions, I can take them, or we can take them later in the end also. So your choice. So let's come to our latest product launch, which is the small cap fund. Why small cap companies? There are 4 or 5 big picture reasons, I would say. First of all, as we say, we are looking at terminal value, which means we are looking at companies which are with a long runway of growth, high growth, and a long runway of growth. As we see, actually, micro, small, and mid caps kind of that space perfectly fits in with that. Why is that? This is because small, micro, mid, that broad space is basically the phase of a company's life cycle, which has the highest growth rate and the longest runway of growth. And we'll see why. In a company's life stage, when it is a startup or a PEVC funded idea, entrepreneur businessman puts in his own money and starts a business. This is the phase of trial and error. This is the phase where nothing is kind of still stabilized. Products, markets, production, quality, funding, equity, debt, everything is uncertain, lot of uncertainty, not proven, etc., etc. And the failure rate is the highest at this point in time. So 6, 7, 8, 9 out of 10 businesses fail. But once you're past this stage, which means that all those things are past and the proof of concept is no longer a problem, you are now an established company, the product, etc., customers are established. Then you come to the small scale SME phase or a micro or small and mid phase. In this phase, essentially, since all those uncertainties of failure are gone, you just have to focus on growth, right? So this is the phase where you're starting small. That means that your runway of growth is very high, very long. And it is also because, again, you're starting from a very small base, the rate of growth is also the highest at this point in time. So it perfectly fits in with our philosophy of terminal value investing, where you are in a high growth phase for a very long period of time. So you become a SME, then a micro cap, and a small cap, and a mid cap. All these phases, 10, 15, 20 years, you can keep growing. And then, of course, you become very large and your markets start getting saturated, probably more competition comes in, etc. Then you become a large company with a more normal kind of a growth rate. But this phase, the phase after the maximum failure phase, this phase, if you're able to capture, that is the fun part. And this is where your wealth creation, your multi-baggers are created. So that's, the first and foremost, reason to look at small companies is that these are the companies with the highest growth phase and the longest runway of growth. Second is, as far as India is concerned, there are certain softer aspects which I mean, we can't quantify, but since you have a lot of clients and some of you are businessmen yourself, it's intuitively, anecdotally, I can say that one thing that has happened in 2019 is that the corporate tax rate was reduced from, to 25% and 15% if it's a greenfield project by a company. So 25 and 15 is the corporate, and the personal tax rate continues to be closer to 40%. So for a promoter, if he was siphoning off money from the company and showing it in personal income, the incentive to pay 40% is lesser than to retain it in the company and pay 15 or 25%. So one of the reasons why you probably are seeing a jump in profitability for a lot of companies over the last 5 years, is my gut feeling is that it is profits that were already there. But now they are actually coming into the company. It's now more beneficial for the promoter to retain the money, grow the company, and pay lower tax rate rather than take it into the personal account. So that's one softer aspect that probably is helping. Second is that promoters have also have understood the game of wealth creation. So if I'm showing 1 crore of profit extra in the company, the multiple that I get is 30 on that, probably 20, 30, 40. So by showing 1 more crore profit here, I increase my market cap by 30, 40 crores, right? And now, given the state of the market, it's liquid, you can encash it, you sell 0.5%, 1% of the company, buy a villa in India or in Dubai, and it's all legit, pay long-term capital gains, and you're good. So this wealth creation and the ease of creating market cap is also something that promoters are beginning to understand. And of course, in social circle, in parties, etc., there is a healthy kind of comparison. इसका market cap इतना है, इसका net worth इतना हो गया, इतना 1,000 crore इसका हो गया, मेरा अभी इतना है. So there is also this wealth creation competition that's going, which is also leading promoters to retain more profits and show more profits in the company. So this is one softer aspect. A couple of softer aspects will probably have not been appreciated earlier. The second is, again, as far as India is concerned, the market has become large. So while we are talking about small caps, the universe is actually quite big. There are about 5,000 listed companies. And if I were to, look at, say, 4 years ago, taking about 2,000 crores as the market cap cutoff, there were 220 companies which we could call small caps with a market cap of more than 2,000 crores. So about 470 companies in all. But if you remove the top 100 large caps and then next 150 mid caps, it leaves you with 220 small caps. So in 2020, we had 220 small caps with a market cap of more than 2,000 crores. Today, that number is close to 800. So there are now 800 companies which can be called small caps with a market cap of more than 2,000 crores. So the number is up by 4x, for example. At that time, the largest small cap was about 7,000-8,000 crores. If you look at the blue bar. If you look at the orange line, so to say, on the right-hand side. So the largest small cap was about 7,000 crores in market cap. Today, the largest small cap is close to 30,000 crores. So again, the size has increased dramatically. So not only has the number of companies increased, the size of those companies has also increased a lot. So they are becoming much more meaningful and significant compared to before. Companies have become global in size now. About 20 years ago, 15 years ago even, your top 100 companies in India accounted for about 80% of the market cap. And the mid and small caps used to be about 20% of the market cap or 17% of the market cap. Today, that number is close to 62%. So only 62% of the market cap is the top 100 now. And almost 40% of the market cap is mid and small caps, about half and half each, half mid cap, half small cap out of that. Mid and small cap each are more than $1 trillion. So while our market itself is about $5 trillion in market cap overall now, it's almost $1 trillion each in mid and small cap. So again, the size in sheer number of stocks, market cap, proportion of the market, by all parameters, mid and small caps have become much larger than what they used to be. So today, if you want a broad-based exposure to India, you cannot ignore mid and small caps because they are now 40% of the market. And in fact, this Sunday itself, there was a lovely article in Business Line that the market has moved on, but the Nifty hasn't. That was the headline. Maybe Meena, you can share that article with the team, the Business Line article. that the market has moved on, but the Nifty hasn't. Because Nifty 50, for example, is comprised of large banks, oil and gas, metals, the large cap IT, which are not growing as fast as the rest of the segments. Multi-baggers, of course, don't want to spend much time, but if you look at the number of stocks in the last 5 years, which have gone up by 5 times or more, it is 6 large caps, 60 small caps. 3 to 5 times, 26 large caps, 64 small caps. So that's the way things are. This is also an interesting chart. I just looked at the small caps which existed, say, 10 years ago. The same definition: top 100 large caps, next 150 mid caps, and then for the sake of analysis, I just took the next 250 as small cap. While as per SEBI or AMFI, there is no definition of micro cap. I just said, let me just take the next 250 as small caps, and then the rest all is micro caps. So that's more than 500 stocks with more than 2,000 crores in market cap. So let's see what happened to those small caps, which existed in 2004. So out of the small caps in 2014, 3 became large caps with an average return of 43x. 43 became mid caps with an average return of 16x. 112 remained small caps with an average return of 5x. And 92 got demoted to micro caps with an average return of minus 10%. So there are pluses also, minuses also, but average is minus 10%. Out of the next, below the 250, 15 became mid cap after the micro caps with an average return of 67x. And 93 became small caps, which are average return of 21x. So about 90 got demoted from small to micro, and 90 got promoted from micro to small. So, when stocks move, this is the kind of wealth creation that is possible. The multiples we are looking at 20 times, 40 times, 60 times. But more importantly, if you see, the market itself is so dynamic, almost 43 out of, say, let's say 50 out of 2, almost 20% of the stocks got promoted. Almost half of them remained where they are. And almost, 30-40% got demoted. So, it's a very dynamic market. It's a very exciting market. It's a very large market in stocks and selection. So, so far we talked about the fact that small caps give you the exposure to a company's life cycle, which is the highest growth rate and the longest growth runway. Second is the India market has become very large in terms of overall market cap, in terms of number of stocks, in terms of the size of the small cap market cap per stock, and also in terms of the proportion of small and mid caps to the overall market cap. So these are becoming a formidable presence in the market, which you can't ignore anymore. So that's more on the number of stocks, size, market cap, etc., and the growth runway. The point is, as we mentioned in the initial part, India is a growth market, and within that, obviously, there are stocks and sectors and themes which are growing even faster. And in our FlexiCap presentation, these are the long-term themes that we talked about: premium consumption, financialization of savings, physical asset creation like manufacturing, exports, infrastructure, real estate, etc., digitization and new business models, all your Zomatos and Paytms, etc. of the world. So all these themes are high growth segments. And if you look at the opportunities in the high growth sectors, 80% of the opportunities are in small caps. So what we did was, as I said, there are about 1,031 stocks with a market cap of more than 2,000 crores. So we split those stocks into high growth stocks and other sectors. So 560 stocks are high growth stocks out of all the stocks which have a market cap of more than 2,000 crores. But if I break up those 560 stocks, 460 out of the 560 are small caps. So almost 80% of the opportunities in terms of the number of stocks is in small caps, in high growth, specifically in the high growth sectors. Now look at some of the high growth sectors. These are not all, but some. The number of opportunities in small caps is 10 times the number of opportunities in compared to large caps. For example, in chemicals, if you think that China plus one, manufacturing, India's expertise, etc., is a structural theme which we do believe. There are 2 large cap chemical companies. There are 65 small caps. In infrastructure, 1 company, Larsen & Toubro, 32 small caps. Logistics, 1 in large cap, 18 in small cap. Real estate, one of the most crucial sectors, 2 large caps, 31 small caps. Capital goods, we are talking about manufacturing, etc., blah, blah. There are 6 cap goods, which are cap good companies, which are large cap. There are 73 small caps. So, I mean, sector by sector, in hospitality, which is hotels, etc., there is no large cap hotel stock. One of the most profitable and fast growing segments today is hotels and hospitality. There is no large cap exposure that you can get. Consumer durables, again, as the demographics, as we know, washing machines, AC, TV, blah, blah, blah. There is no large cap stock. Electrical, there is no large cap stock. So auto ancillaries, again, sunshine sector, etc. There is no 9 large cap versus 67 small cap. So in high growth stocks and segments, sometimes you have no choice but to look at mid and small caps. The index itself is fairly more diversified. The large cap Nifty 100, for example, has a lot of exposure to financial services, oil and gas, you can IT, but the large cap IT, commodities and metals, whereas which are more mature segments as well as global in nature. The small cap index has more exposure to the domestic looking sectors, more and the faster growth segments. So, and it's more diversified, less concentrated also. So as you can say, most of the options available in a lot of these segments are in the large cap space. Even if you look at segment leaders, for example, the largest AC component manufacturer, for example, your Amber, largest wealth manager, 360, second largest wind energy, wind turbines manufacturer, Inox, CDSL, Dr. Lal, MCX, Titagarh, Century Ply, your Kajaria, your DOMS, which is the kid stationery manufacturer, luxury watch retailing, for example, Ethos, leading mutual fund distributor, which is Prudent. So many of these stocks, if you see, all of these are segment leaders, but they are all small caps even now. So sometimes, to repeat the thing, in some of the segments, sub-segments, even the leaders are still small caps. So that's the third, fourth point that we wanted to talk about, that the options really are sometimes only in the small cap segments. Wealth creation, you're all very familiar with the data, 18.2% CAGR over 10 years against large caps, which is 14.7% CAGR. Within that also, there's a lot of scope for stock picking. For example, in 2022, even when the indices did not do much, the index returns, for example, were hardly anything. The top 10 stocks were up 142%, and the bottom were down minus 60%. This is for the small cap index. Even for the mid cap index and the large cap indices, the difference between large and small, the top performing and the bottom performing stock was quite large. So, people say, what do you think about the small cap index performance? I said, yeah, index matters, but not beyond a point, because the choices are so many, because there is so much diversity. There is always scope for stock picking. So is now a good time to enter? Are the small caps expensive? We don't believe so. If you look at the 1 year forward PE for large caps and small caps, which is the orange and green, they are pretty much at similar levels. The mid cap 150 index is a tad expensive, as you can see, 28.8. But the large and small indices are trading at similar valuations. And if you look at the earnings growth is much better for small cap, 18% compared to 8%. So if you adjust for earnings, the PEG ratio, as you say, is almost 1 for the small cap index compared to the large caps. So we don't believe that even if you look at the next couple of years, small caps are that expensive. The ROEs, the quality, as you can say, are similar for large and small. Mid is a bit lower. I think this mid cap 150 stocks in middle are probably because of this artificial definition overvalued, because all the multi cap and flexi cap tend to put at least some money there by force, and that's leading to these valuations. But if you look at the large cap part and the small cap part, that that still looks fine. So I think to summarize, our philosophy, is perfectly suited for small cap. We talked about why small cap. Let's just quickly revise about why small caps. The highest growth phase in a company's life cycle and the longest runway. The universe is becoming large. We talked about the size of the stocks. We talked about the fact that some high growth stocks, sectors, and themes are available only in small caps. And there is enough scope for stock picking and long-term wealth creation, as we saw in the historical returns and the prospective returns and the prospective earnings growth, as well as the variation we talked about. So I think all the rationale for small caps combined with our terminal value investing makes us quite confident that we have enough juice left in the market for our small cap fund. So that's where we stand. Thank you so much.
Thank you for very informative presentation. So, team, if you have any question, you can put it on the chat.
Hi, Mir.
Hi, boss.
On behalf of the team, I have one question. What will be the size of the portfolio? How many stocks?
I would prefer to keep it at around 60 stocks.
And maximum, minimum weightages?
Typically, in a small cap, so for example, in the flexi cap fund, my small cap is about say maximum 2 to 3%. In the small cap fund, per stock, probably we are talking about 4 to 5% max.
And there'll be a long tail or small tail?
नहीं, अभी 60 stocks होएगा तो small tail ही रहेगा ना.
But less than 1% weightage at the stock में.
Maybe a few stocks, not too many. I'm not a big fan of having a tail.
And churning?
Churning depends on the situation, frankly. Ideally, as we discussed last time also, we would like to buy and add actually, because we buy with a certain thesis, certain assumptions. So you buy 1 or 2% in a stock, and then you keep tracking it, see the results for the next 1 to every quarter. And if your original thesis is turning out correct, then your confidence actually increases and you keep adding to the position. So our approach is not buy and hold, but buy and add, so to say. But we are not, what you can say, fanatical. We are practical. So in our flexi cap fund, as a live, it's easier to give a live example. We are still very bullish on this whole defense space, manufacturing space. It's a structural story. So in our initial portfolio of May, we had almost 22%, almost 23% at one point in time exposure to all these manufacturing, defense, power, railway, that kind of thing. One of the biggest exposure in the industry. But in July, in June and August, there was a bunch of funds which came up in the same thing, defense manufacturing karke. So they all bought the same stocks in June, July that we already held in the portfolio, and they went up by 30, 40, 50% in a short period of time. So what we thought we would make in 1 year, 2 years, we made in like 2 months. So then we booked. But that's not because we wanted to trade out or anything like that. But if the market is giving you some temporary spike, then you want to capitalize on that. So we actually, and we are not averse to taking active calls for that. So from 24%, we actually brought it down to almost 9%. but I'm looking to buy again. So we are practical about it, but we're not momentum traders. Let me put it that way. ये तो by as luck would have it, 3-4 फंड एक साथ लॉन्च हो गए डिफेंस मैन्युफैक्चरिंग थीम में, बिजनेस साइकिल वो सब, और घूम फिरा के वही स्टॉक लेते हैं सब.
A few words on the market outlook, short term and long term.
See, market outlook is short term में structural में बोल रहा हूँ क्या हो रहा है. Structurally what is happening is that globally the default is printing. The US and especially US and of course Europe also because of lower growth rate, the post-COVID debt to GDP spike has been so high that now if you've seen the news articles, right, that a larger component of fiscal deficit, fiscal budget in the US is already going for, it's more than healthcare, more than defense is going for interest payments now. So it's actually like a developing country now, which used to be the case for developing countries, right? Now it's happening in the US, but nobody talks about it. So the point is that they can't sustain 4% bond yields, 10-year bond yield, to service those high levels of debt. So they will have no choice but to cut rates, flood liquidity. Half of the US debt is actually short term, coming for maturity in 2 years. उसको refinance कैसे करेगा? At 5% interest rate, they can't refinance. They'll have to cut rates. So while they make a show of controlling inflation and all, I think structurally core inflation will remain higher. Structurally, they will keep printing money, which means that asset classes will continue to stay afloat. Basically, bottom line यही है. It's the worst time in history to be an asset poor person. Whether you need to own assets, whether it's stocks or real estate or gold, whatever, because money will have no value. So that's the end game ultimately. That's what's happening. And जो world में होता है ultimately उसका impact इंडिया में तो आता ही है. India is of course anyway a growth island in the world. So it's the fastest growing large economy. जो tag है वो तो है ही अपना. And that's to our advantage. So equity flows, bond flows will continue to come to India. So to that extent, the global structural money as well as the local structural money will continue to flow to the equity markets.
There's a question in the chat box. The first two I'll respond. Sir, how much time will it take to complete off your fund? Is there any guideline or strategy for cash or remain invested in terms of percentage? I think he's asking about investment. How much time will you deploy funds?
About 2 to 4 weeks. So flexi cap में भी हमने वही बोला था. We will try to invest within 2 to 4 weeks. Again, it's not like we are going to collect 5,000 crores. So it's fine. We'll be able to invest that. Unless we are not big fans of again taking cash calls. So flexi cap fund में भी we had said that 2 to 4 weeks, and we did that.
And what will be the market cap breakup? Small cap, large cap, mid cap in this fund?
It will be all
No, like full 100% small cap. It could be like
100% तो ना नहीं हो सकता शायद. Cash होगा. But 65% anyway.
Yeah, that is mandatory.
Is mandatory. I would say 80% plus तो होना ही चाहिए small cap.
And then mid cap.
I don't know really. I would prefer not to have too much mid cap and large cap in any case.
So it will be like a true to label kind of fund.
Yeah. We want to run it true. We always want to run it true to label.
Okay.
So in fact, in FlexiCap also, we had said that we are going to be market cap agnostic because that's the mandate, right? We will find and pick the stocks which are best in terms of growth and valuations in our equation, irrespective of market cap. So and the question was whether you're going to run it as a large cap fund. I said I don't know, and I don't think so. So as we stand as of August, we had about 30% small caps in the FlexiCap fund also, and about 18% mid caps and 45% large caps. So there also we run it at 2 to level. If we found 30% good small caps, so we put that. Here also, when we say it's a small cap, we'll try to have the maximum small cap only. And see, point is, Some of the funds keep large caps, etc., because they are too big in size. We don't have that problems, at least in the beginning.
So ideal size you're looking at up to fund size.
अरे उसकी चिंता मत करो, पैसा लाओ.
So
No,
you
I don't think. See, again, this is a question. I don't know why, SEBI this created this scare of stress test and all that. देखो, मैंने कहा इंडिया का मार्केट कैप टोटल है साढ़े 400 लाख करोड़. ठीक है.
1.5 trillion.
हाँ हाँ, 450 लाख करोड़ है इंडिया का मार्केट कैप. 460 आई थिंक, बट लेट्स से 450 लाख करोड़. उसमें से small caps are approximately 90 lakh crores. We said na 1 trillion के ऊपर थोड़ा. So 1 trillion is about 84 lakh crores. So 90 lakh crores जितना है small caps. 1.1, 1.2 trillion जो भी है. So 90 lakh crore जो है वो small caps है. What is the size of the largest small cap fund?
50,000 crore.
It's 0.5%, yeah. 0.5% of 90 lakh crores. And even that fund will not have 100% small caps.
Yeah.
राइट. सो इस स्ट्रेस टेस्ट में क्या मतलब है? चलो फ्री फ्लोट 50% लगा लो, प्रमोटर होल्डिंग 50% है तो फिर भी 1% नहीं होता. सो दिस अननेसेसरी स्केयर है सर. साइज शुड नॉट मैटर एक्चुअली.
One structural question, maybe slightly off. What happens when in next couple of years we become fiscal surplus?
Who? We.
The market, the Indian economy becomes fiscal surplus.
फिस्कल सरप्लस कैसे होगा?
From fiscal deficit, we are moving towards a stage where we might actually become fiscal surplus.
नहीं, करंट अकाउंट हो सकता है, फिस्कल कैसे हो सकता है? फिस्कल मुश्किल है, करंट अकाउंट हो सकता है.
Okay.
हाँ, बीओपी तो एनीवे है,
Right.
बट करंट अकाउंट good chance we can actually become a balance. Fiscal, I don't think in 2-3 years. It can maybe in 10 years, yes, if we really grow fast. And but point is, do we really need to be fiscal surplus? So because if you're spending in the right way, then if the government is spending on infrastructure and capital expenditure, it's not a bad deficit. Now, if you're spending on freebies, then it's a bad deficit.
Right. So you suggest investing in this fund direct or like through a SIP mode or lump sum? Which one you suggest? Or you are okay with lump sum?
I am okay with lump sum, but again, it's a function of the client's own asset allocation. Na? What is the current asset allocation?
Okay.
Yeah.
So next question is ideal time frame to invest in small cap if it's a lump sum? 3 years, 5 years.
Again, see, does the client already have a lot of small cap funds? Then you want to stagger it out. But if he doesn't have too much exposure currently to small cap funds, then you can put lump sum.
Okay, and what should be investment time horizon for this kind of fund?
Any equity is 5 years, no? At least.
Okay.
And NFO dates, if you can repeat again, Meena.
The NFO opens tomorrow, which is 11th of October, and closes on 25th of October.
25th.
Yes, sir. 25th of October. It closes on 25th of October.
Right. Sure.
Okay. So team, if you have any other questions? So Mihir, if you can just finally you can touch upon FlexiCap also, like how it is doing and what you see in that. FlexiCap.
FlexiCap, sure. Let me see if I have the slides here or not. Can you see the screen?
Yes, yes.
Okay. So just a quick update on the FlexiCap fund. This is as of August. We haven't updated the slide for end September yet. Meena, if you could share that also after this.
Sure, sure.
Okay, but broadly the NAV is more than 20%. I mean 12 rupees now. So we've delivered over 20% returns and beaten the benchmark, of course. As of August, we had outperformed the benchmark by about 3%. As of August, we had about 6-7% of cash. Top 10 was 27%, largest stock was 4%, top 3 sectors 45%. We had said 40 to 60 stocks, so we're keeping it at 60, broadly 60 stocks. The mid-small exposure, as you can see, was about 25%. As of September, it was also closer to 27% or more in small caps, mid cap 24, large, this one as compared to the Nifty. So as we said, we are not averse to taking bets on that. Just to give you a flavor of, when we say terminal value investing, growth investing, these are the kind of stocks which come up. Out of the 60 stocks, these are the 30 stocks. So top 10 small caps, top 10 mid caps. So this gives you a good flavor, of what we are looking at.
Okay.
And this is what we are overweight and underweight on as of August. Healthcare, good exposure. Cap goods, as I said, it used to be almost 22-23%. It's down to 9%.
Perfect.
Financial services will continue to remain close to the benchmark weightage.
So that's a very thank you for asking that question. So financial services, what we are doing is while we are broadly a little bit underweight only, we are quite underweight the lenders versus the non-lenders. Okay, so within the lenders are banks and NBFCs. So and within the lenders also we are underweight on banks versus NBFCs. Okay, so private sector as well as public sector banks we are underweight. NBFCs we are relatively overweight within the lenders, but overall we are underweight the lending part, and we are overweight the non-lenders. Non-lenders mein aapka, we have prudent, for example, mutual fund distributor, insurance, broking, asset management, MCX, commodity exchanges, etc., capital markets basically. So we are more towards the capital markets and the wealth management and the savings pool compared to the lending part. So that's how we are positioned within the financial services. So overall, dikhta hai ki, it's a little underweight, but within that, it's a lot of active bets.
And between the lenders, the reason why the weight overweight towards the private sector and the financial institutions rather than the banks.
So NBFCs compared to banks, because we are expecting now interest rates to start coming down, and banks in general have a larger proportion of floating rate book. So when rates come down, immediately the asset book will reprice down, and then after a lag, the deposit book will reprice down. So there'll be a temporary hit in the margin in the shorter term for the banks, and same for housing finance also similar. The books are more floating rate. NBFCs typically your consumer durable financing, your unsecured loans, your commercial vehicle loans. All those are mostly fixed rate loans. तो उनको फर्क नहीं पड़ेगा रेट कट होगा तो, बट उनका जो बोरिंग कॉस्ट होगा वो नीचे आएगा immediately because they are wholesale borrowers.
Right.
So tactically, in the short term, NBFCs might do relatively better. But then we again have to be careful because RBI is going after them, especially the high risk loans. unsecured, etc. So we have to pick and choose the better ones then.
Right. Any other questions, friends?
So, Mihir, one last thing about small cap. So you will be touching beyond 500 stocks also, like micro cap also you'll be investing in?
Oh yeah. ये तो see, as I said, ना 2000 crore से ज्यादा 1100 stocks हैं. 1100 में से 250 निकाल दो large और mid. 100 large and 150 mid. फिर भी 850 स्टॉक बचते हैं. तो ये तो यूनिवर्स है ही to start with. But we can go below the 2000 market cap also. In fact, in our flexi cap fund also we have stocks which are less than 2000 crore market cap.
Okay.
But this 2000 crores is just for convenience as a, 5,000 stocks का example नहीं दे सकता मैं. So bulk of it will be probably in those 850 stocks only. But then we can selectively go below that also.
Okay. And equity market looks stable to you, like nothing to worry.
Equity market looks stable, as I said, because the global central banks and governments don't have a choice but to keep pumping it.
Sure.
Geopolitical notwithstanding in the short term?
Geopolitical, if the Iran thing escalates into a nuclear war and all, we are not betting for that. Hopefully, But oil structurally will not go up. That's what इतना टेंशन के बाद यूक्रेन, ईरान, इराक, सऊदी सब करने के बाद अगर ऑयल 70 क्रॉस नहीं कर पा रहा है डिसाइसिवली, then structural problem ही है. Because China is slowing down, and in 5 years China will anyway be all EV. US is anyway the world's largest exporter of oil now. Not exporter, the world's largest producer of oil. So I think oil का तो game over है, and India का biggest threat used to be oil only.
Still it is oil.
Yeah. But again, compared to 2013, oil as a percentage of GDP is half. See, 2013 में भी अपना net oil balance was $80 billion, $80-90 billion, right? आज भी net oil balance is $80-90 billion, but economy is doubled, no? So the percentage dependence on oil is reduced.
Right.
Sensitivity has reduced. And on the other hand, software exports used to $100 billion, वो हो गया $200 billion. So that's why our current account is much more healthier than 2013. Na? So hopefully we won't see that fragile 5 wala situation anytime now.
I think they are through. All questions are through.
Yes.
Pankaj, you can.
Yeah. So Meena Rupani, she's our relationship manager. She'll be in touch with all our branch managers and all. Yeah. So any support you require, you can reach out to us. Yeah.
Let's go out all out and do some good numbers in this.
Yes. Yeah. Thank you so much. All I can say is that, anyway, thank you so much for the support during our first NFO. And that was, as I said, all on paper. It was just based on a PPT and my face and Utpal Seth's face. But now we have at least demonstrated in the FlexiCap fund what exactly we talked about, what kind of stocks, and when we talked about the philosophy, how it translates into the actual portfolio, that we have clearly demonstrated. And performance, of course, short term is there for all to see. I think since inception, we should be in the top 9-10 out of the 40 peer sets. Not a bad start. So the point is that at least now, though 5 months is not really a time to judge, but you have some 5 months of portfolio to see how we have actually executed. And this is the same philosophy we'll execute for the small cap fund. So compared to last time, the confidence level should be much higher. So we expect far more, strong support from you, and hopefully will not disappoint.
Right.
I'm sure you have added more members to your team.
So we have new members. I think we have 5 analysts, 2 fund managers, including myself for equities, 4 people on the fixed income side. So total team of 11. Team to hai.
Okay.
Thank you so much, Mir, for your time.
Thank you for having me, and look forward to seeing you in person also whenever. Thank you.
Thank you, Pankaj sir. Thank you, Shashank sir. Thank you for giving us this opportunity. We look forward to your support.
Sure.
Anything needed, please feel free to get in touch. We'll be more than happy.
Yeah, Mir,
Thank
can
you.
you
Thank
your
you. for your
branch
support.
coordinates,
Thank you so
all
much.
India branch coordinates once again.
Sure, sir. Sure, sir. Definitely. We'll do that. We'll do
Yeah.
that, sir. Yeah.
Okay.
Thank you so much. Thank
Thank
you.
you.
Thanks.
Thank you,
Thank you, Meer sir. Thanks. 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 Thanks.